when should we all buy ETFs and speculative stocks in size? Well, you want to do it when an indicator called the VIX hits 70. And I'll talk about this quickly because I have discussed this before. So the way it works is if you go to finance.yahoo.com and you type in VIX, there we go. The VIX is actually an indicator of what the market thinks volatility is going to be in the S&P 500 in the next 30 days. And what happens is when the VIX is really high, it means investors are expecting a lot of volatility in options. And I teach all about options and hedge funds and advanced portfolio management in my MBA program. So when the VIX spikes to above 70 or so, like it did in 2008, and in March of 2020, actually it spiked above 80, that means there's maximum fear out there. And you have to back up the truck and buy a lot of stocks or ETFs or even speculative companies because they do incredibly well because there's mean reversion and they bounce back. And if you have questions about options or any other asset class, please let me know because, as always, I'm here to humbly help you. Now, since rates are going up, it makes sense to think about, of course, buying bonds. So please do your own research on this and look into buying government bonds in your country if the risk is low. Now, what I did was I purchased risk-free, that's right, risk-free United States government bonds called I-savings bonds at a yield of 9.62%. And the way I did this, and I'll show you in a second, was through a government website called treasurydirect.gov, which is a no-brainer of an investment decision if you live in the United States, in my humble opinion. Now, if you don't live in the United States, you might want to look into buying bonds in the country you're based in, but make sure you do a thorough analysis on it to make sure that they're inflation protected. Let me explain this in more detail. Okay. So let's go together to a website called treasurydirect.gov. This is a government website. And you can only buy Series I savings bonds from treasurydirect.gov, right from the government. And these bonds are issued by the United States government because they want interest rates to go up, similar to what I explained before. So what happens, and here's the 9.62% right here, which I'll explain in more detail in a second. So what happens is if you invest up to $10,000 in purchasing a Series I savings bond, then the government gets your money, okay? And they take that money out of circulation, as I explained before. And when they get rid of the money and take it out of circulation, then the supply of money goes down and the price of money, meaning interest rates, goes up. So this 9.62% bond right here, it's available to buy up until October of this year. And then on November 1st, they announced the rates that for the next 6 months, for the next series of bonds you can buy. Then on May 1st, they announced the rate for the next 6 months after that. Rinse, lather, repeat. Every 6 months they do this. And so the rate is 9.62% now, but every 6 months, the rate on this bond will change based on what the rate of inflation is and what the government's interest rates are. So please buy these for your kids. They're wonderful investments. There's a limit of $10,000 per person. It's a no-brainer. And you can open an account at this government website here called Treasury Direct, okay, treasurydirect.gov. And you cannot sell these in under 1 year, though, without penalties. There's also another rule that if you sell it within the first 5 years, you give up 3 months, meaning 1/4 of performance, which isn't that bad. Okay, so this is the absolute lowest risk investment in the world. Okay, so the very last company, it is what it is, to go bankrupt would be the United States economy. It's been that way for several decades. Again, this is the lowest risk investment in the world, as you can't lose money because you receive the fixed rate of whatever the interest rate is, plus, here's the kicker, you receive more because they account for inflation. Okay, so technically, if I own this, and I do, I get 9.62% annualized. And let's say that by November 1st, inflation is much higher, and so the government raises rates more, then I make more money for the next 6 months after that. However, if inflation goes down and interest rates aren't going up much, then what happens is by November 1st for the 6 months after that, I actually get a lower rate. Okay, but you never lose any money on this. Okay. So the rate of the Series I savings bond changes every 6 months. So again, if I own it, then at the end of October, if inflation is higher, then the return on this bond will be higher than 9.62% and vice versa. If there's deflation, you can't lose money ever, as it's risk-free.